Imagine watching a blockchain network designed to scale suddenly start behaving in a way nobody expected. Not during a bull run, not during network congestion, but during a period when fees are dropping, withdrawals are surging, and activity is shifting in a direction that could redefine Ethereum's entire ecosystem. That is exactly what's happening right now across Ethereum Layer-2 networks, and most crypto investors still haven't connected the dots. The recent spike in ETH L2 withdrawals and the fastest fee drop Ethereum has seen in years are not random events. They are signals of a major transition in how liquidity flows, how users interact with the network, and how value moves across the Ethereum ecosystem. To understand why this matters, let's go back to why Layer 2s exploded in the first place. Ethereum became the foundation of DeFi, NFTs, and smart contracts, but it came with a cost: high gas fees during peak demand. Layer 2s were created to solve that problem by processing transactions off-chain and settling them back on Ethereum. For years, the narrative was simple: users move funds onto L2s to escape high fees. But now, something unexpected is happening. Even as Ethereum gas prices fall to some of the lowest levels in recent cycles, withdrawals from Layer 2 networks are increasing instead of decreasing. That means the story is no longer just about cheaper transactions, it's about shifting behavior. The Layer 2 adoption 2025 trend is entering a new phase. People are no longer using L2s only for savings, they're using them because that's where applications are actually being built. Activity is not just migrating, it's concentrating. And when that happens, liquidity starts to reorganize. The surge in L2 withdrawals is not simply users abandoning networks. In many cases, they are bridging assets between Layer 2s rather than returning to Ethereum mainnet. Funds are moving laterally instead of vertically. This is the first time we are watching an ecosystem inside another ecosystem form its own internal economy. But the bigger story isn't withdrawals. It's why fees are dropping at the same time. Ethereum's recent fee decline isn't a sign of reduced demand. It's proof that the scaling roadmap is working. As more transactions move to L2s, mainnet bandwidth increases. And unlike previous cycles where fees dropped because usage collapsed, this time fees are dropping while network activity remains stable. That means efficiency, not weakness, is driving the trend. The Ethereum fees' lowest ever moment is not bearish. It's the clearest sign yet that Ethereum is evolving from a congested bottleneck into a settlement layer for a multi-chain ecosystem. Now let's break down why the withdrawal surge is catching analysts' attention. When funds leave L2s, it can signal several things: profit-taking, liquidity rotation, preparation for airdrops, or shifting incentives. But the current withdrawal patterns point to something bigger. Users are positioning ahead of anticipated changes in L2 reward structures, new token launches, and interoperability expansions. The biggest Layer 2s are preparing updates that may reshape user incentives, and early participants are moving assets strategically, not reactively. Some networks have already hinted at reward phases. Others are launching native tokens. Some are integrating cross-rollup transfers without routing through Ethereum. And the emergence of shared sequences, modular rollups, and unified liquidity layers means users may soon move funds between L2s instantly and cheaply without ever touching mainnet. That explains the quiet repositioning happening under the surface. But there's another layer to this trend: competition. The L2 ecosystem used to be a two-player race. Now there are dozens of networks fighting for adoption in gaming, DeFi, privacy, AI execution, and enterprise-grade scaling. The fee drop accelerates competition because low-cost execution becomes the default expectation. When gas costs disappear as a user friction point, the only thing that matters is experience, liquidity, and incentives. That means the next wave of winners won't be decided by technology alone. They'll be decided by where users actually choose to stay. What makes this even more important is timing. Ethereum is entering a period of fundamental transformation. Proto-danksharding, data availability improvements, and L2 compression upgrades are about to reduce costs even further. And when the base layer becomes optimized for settlement instead of execution, L2s evolve from optional tools into mandatory infrastructure. This is why institutional interest is shifting, not just into ETH as an asset, but into Layer 2 scaling as a technology. If Ethereum becomes the global settlement layer for tokenized assets, L2 throughput becomes the backbone of the digital economy. Now let's talk about how this affects price behavior. Historically, network usage and fee pressure correlated with bullish price action. But the new cycle disconnects those signals. Low fees no longer mean weak demand. High L2 activity no longer drains mainnet value, and withdrawals no longer indicate exit liquidity. Instead, capital rotates within the ecosystem, creating a more complex dynamic where liquidity can expand even while cost decreases. This is why traditional metrics no longer tell the full story. For investors, this shift changes everything. Tracking L2 deposits and withdrawals becomes more important than tracking Ethereum gas spikes. Monitoring bridge activity becomes more predictive than monitoring exchange inflows. Understanding how capital rotates between L2s may become as important as understanding how capital flows between altcoins. And watching where developers build may become the single most reliable indicator of long-term value. But here's the twist. Ethereum's evolution is not happening in isolation. Competing ecosystems like Solana, Avalanche, and modular networks are pushing execution-focused designs that don't require L2s at all. That means Ethereum's scaling success doesn't just strengthen Ethereum, it determines whether it remains the dominant smart contract platform. If L2 growth continues accelerating, Ethereum becomes unbeatable. If L2 fragmentation weakens liquidity, alternative chains gain ground. The withdrawal surge is not a threat, it's a turning point. As we approach the conclusion, here is what most people still haven't realized. The future of Ethereum won't be defined by mainnet usage alone. It will be defined by how efficiently the ecosystem can scale horizontally through Layer 2s. And the current trend, rising withdrawals and falling fees, isn't a warning sign. It's the beginning of Ethereum transforming into what it was always meant to become, a global settlement layer powering a multi-chain economy. The key question now is not whether L2s will grow. It's which networks will survive, which will lead, and which will quietly disappear. Investors who understand this shift early will stop reacting to headline noise and start watching the movement of liquidity, not the movement of gas charts. Thank you for watching, stay ahead of the narrative, and I'll see you in the next video.